Welcome to the fixed income update. A new year, so wishing everyone a very happy new year. This summary will be a bit longer than the usual. We'll be wrapping up 2022, a look back, and a bit more difficult part, looking through 2023. So 2022 was a unique year, in fact a very humbling year. So how do we look, if we were to look back at 2022, the most interesting thing unfortunately was a human crisis, which was the war. Financial markets have rarely seen war for such a long time. B, it was unique for the developed markets. They haven't seen inflation at 8% plus in the last 4 decades. Inflation was a thing for the emerging markets, but never for the developed markets. And for the first time, large swathes of developed market saw what inflation looked like. That was unimaginable for them. Third was inverted yield curves. Now we haven't seen it for a long time across developed nations. Again, part developed nations, US, UK, they saw inverted yield curves wherein the 2-year rate was more than the 10-year rate, which implied recessionary trend going ahead. Some parts of emerging markets like Hungary and Chile too also witnessed an inverted yield curve. Fourth, inflation was high as we're talking about, but it was manifested by a very volatile commodity prices, crude and agri commodities. A bunch of inflation, and then you add a recipe of service inflation, which is rent inflation in developed markets, that really took people by surprise. And central bankers were on a rate upwards movement. In fact, the US central banker got it horribly wrong. A year back, they had talked about the Fed fund futures rate for December 2022 at 1% through their dot plot diagram. They ended the year at 4/4 to 4/2. They got it horribly wrong. Domestically, India rates, the 10-year moved up by 80 odd basis points from 6.5 to 7.35. The short end of the curve moved slightly, much more than the 10-year rate, which was 200 to 250 basis points. The currency did terribly well. I mean, the the INR USD gave up some 11% appreciation, which was terrible by Asia and emerging standards. We probably bettered only the Turkish lira and the Argentine peso, but the currency was a real underperformer. So with all this, how do we look at the new year? I mean, they say the certain trends which cannot go on have to stop. We believe this can possibly happen. One is the inverted yield curves are rare phenomena. They don't occur for too long. So things have to change there so that the inverted yield curves move to the normal yield curve. That's one. B is we think inflation can possibly slow down and global central bankers have to move to a pause mode. Three, commodities and crude, which some people think can move up because of China opening up. We believe that they haven't completed a cycle. They can be the infant terrible in the markets, but we have to watch out. Our view is that they will be stable to maybe a downward bias. For the rates purpose, we think RBI is at the fag end of the repo rate hike. We believe the rates should come off as we go ahead with falling inflation. So we accordingly are preparing our portfolio based on the view of peaking out rates. So what should the investors do for the fixed income schemes? We believe they should move up the risk continuum. Investors who are comfortable with ultra short term can look at low duration or short term, but overarching bias should be because of a very healthy carry. Fixed income offers a very decent risk adjusted returns. For investors beyond 1 year, they can look at short term and add a dash of dynamic bond fund. Thank you for listening to us and wishing you again a very happy new year.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.